If you are currently holding a long-term care insurance policy, the next 30 days are the most critical period you have faced since you first signed your contract. Inside mailboxes across the country, a specific letter is arriving that is going to raise annual premiums by 40 to 100%. This is not a clerical error or a temporary rate adjustment. It is a long-predicted financial reckoning that the insurance industry has been preparing for since at least 2012, and they are now transferring the entire cost directly onto retirees on fixed incomes in 2026. Here is the part that almost no policyholder is told when this notice arrives. You are not helpless and you are not limited to the options printed on that paper. Most seniors believe they have only one choice: either pay the massive new premium or let the coverage lapse. In reality, you have 4 distinct paths. One of these options relies on a federal regulation that went into effect in January of 2026, which has received almost zero public attention. Another involves a coverage framework that did not even exist a decade ago, and a third allows you to walk away from the contract entirely, but only after performing a specific math calculation, because dropping the policy incorrectly will cost you far more than keeping it. In the next 14 minutes, I will show you exactly why this crisis is hitting seniors right now, what happened to federal workers who thought their group status protected them, and the 4 decisions you must make before you sign any response to that insurance carrier. Pay close attention to how this structural problem developed, because the reason it is peaking in 2026 is key to understanding which option is the safest move for your household. Let me outline the 5 promises this video will fulfill. First, we will examine the precise actuarial miscalculation from the 1990s and 2000s that created this premium crisis, explaining why state regulators legally approve these staggering increases even though they feel like a breach of contract. Second, we will reconstruct what happened to federal retirees enrolled in the Federal Long-Term Care Insurance Program, a quiet enrollment freeze and subsequent premium spike that went completely unreported by major media. Third, I will explain Section 334 of the Secure 2.0 Act, a federal rule that took effect in 2026, allowing you to withdraw up to $2,500 annually from your IRA or 401k to cover qualified long-term care premiums without paying a 10% early withdrawal penalty, a strategy most financial planners have not yet discussed with their clients. Fourth, we will deconstruct hybrid long-term care policies, exploring why the insurance industry has shifted toward them and the single scenario where they actually make financial sense. Fifth, I will give you the self-insurance calculation, the exact math equation you can run at home to determine whether keeping your current policy is a rational financial decision or a waste of money. I will deliver all 5 of these promises before the end of this video. My name is Caleb Maines. This channel is dedicated to analyzing insurance industry mechanics that directly affect seniors and those planning for retirement. The research presented here is drawn entirely from public regulatory filings, rate increase approval records from state insurance commissioners, the statutory text of the Secure 2.0 Act, official releases from the Office of Personnel Management, and published actuarial papers. I do not claim any professional credentials, and I am not an industry insider. My authority comes from spending the time to locate, verify, and explain public documents that most retirees have neither the background nor the desire to search for on their own. That is the sole purpose of this channel. Let us look at a retired school librarian named Margaret. She is 71 years old, living in Columbus, Ohio, where she spent 28 years managing the library and media center for a local middle school. Margaret is a widow. Her husband passed away 4 years ago. Since his passing, she has had to handle the household finances completely on her own, a responsibility she describes as a steep and unexpected learning curve in her retirement. Every year, Margaret pays $4,200 for an individual long-term care insurance policy she bought back in 2003. She was 48 at the time, and her husband had researched the policy, believing it would secure their future. She still remembers sitting at their kitchen table signing the papers. The sales agent assured them both that their premium was locked in. It is because of those specific words, locked in, that she now sits staring at an envelope she has opened and read 3 times, convinced she must be seeing things. The notice states that her annual premium is increasing to $8,400. That is a full 100% rate hike. To put this in perspective, Margaret's monthly income consists of $2,800 from Social Security and a $600 teacher pension, totaling $3,400 per month. Her home and her car are fully paid off. She lives very modestly, yet this new premium breaks down to $700 every single month. That represents over 20% of her total monthly income. More precisely, it means she must hand over more than 1 full month of her Social Security income every year to pay for a policy she has kept active for 23 years and has never once made a claim on. In a spare bedroom, Margaret has a metal filing cabinet. Her husband organized the drawers and labeled them in his own handwriting before his illness. She had not opened the drawer marked long-term care since he passed, but after receiving the letter, she pulls out the original policy, the annual statements dating back to 2003, and the company phone number. When she calls, the customer service representative informs her that the Ohio Department of Insurance has legally approved the rate increase. She is told she has 30 days to make a decision. The representative presents 3 choices: pay the double premium, accept a reduced benefit amount, or let the policy lapse. 3 options. That is the official position. But there is a 4th option. It is a choice her insurance company did not mention, and the agent who sold her the policy never called to explain. It took effect in January of 2026, and it completely alters the financial math for her household. Margaret's story is a composite built from actual public regulatory filings and consumer complaints submitted to state insurance commissioners across 12 different states during 2025 and 2026. The financial figures are completely real, and her income is highly representative of the median retiree in her age bracket. If you are between 65 and 75 and hold an individual long-term care policy purchased between 1995 and 2010, Margaret's dilemma is not a rare exception. It is the typical experience. To understand why this is happening, we have to look at the structural mechanics of how these policies are designed and why the crisis has peaked in 2026. The insurance industry classifies long-term care as a long-tail product. This means customers pay premiums for decades before ever submitting a claim, and once a claim begins, it can run for years. This massive time gap requires long-range forecasting. When an actuary priced a policy in 1998 or 2003, they had to project 3 separate variables: the lapse rate, the percentage of people who stop paying their premiums and abandon their policies before ever filing a claim; the future direction of interest rates, since premium dollars are invested to build up reserves for future claims; and the ultimate duration and cost of long-term care claims. Every single one of these forecasts turned out to be completely incorrect, and all of them failed in the direction that cost the insurers money. First, the companies assumed that about 8% of policyholders would drop their coverage every year. In reality, the annual lapse rate was closer to 2%. People recognized the value of the coverage and held on to it. This left insurers holding far more active contracts than their financial models could support. Second, interest rates plummeted after the 2008 financial crisis and remained near zero for more than a decade. The investment yields that were supposed to fund future payouts never materialized. Third, life expectancies increased, and the duration and average cost of nursing home and assisted living care soared far past what the actuarial models from 20 years ago anticipated. The inevitable outcome is a massive funding deficit. These policies were priced for a financial environment that simply does not exist. Because traditional long-term care contracts cannot be canceled by the insurance company as long as you pay your premiums, the only legal mechanism carriers have to cover their losses is to petition state insurance regulators for premium increases. These requests require rigorous actuarial proof of losses. State regulators review the data, and while they may modify the requested hikes, they approve the vast majority of them. This rate-climbing process has been underway for over a decade, but the pace has accelerated dramatically in recent years. Major carriers like MetLife, Unum, and Prudential completely walked away from selling individual policies years ago. This left the remaining active issuers, primarily Genworth, Transamerica, John Hancock, and a few regional players, holding a shrinking, aging pool of high-risk policyholders without any new premium revenue from younger, healthier applicants to offset the risk. When an insurance block stops growing, it ages. Claims spike, reserves deplete, and the only remaining option is to raise prices on the existing customers. The premium shocks hitting retirees in 2026 are not a new phenomenon. They are the cumulative result of a 20-year systemic failure. Many insurance companies managed to delay these rate hikes through corporate reserves and reinsurance agreements, but those financial shock absorbers are now exhausted. The letters arriving in mailboxes today represent a bill that can no longer be deferred. What almost no policyholder is told during that 30-day decision window is that while the premium increase is legal and permanent, the response you choose should be far more strategic than the standard 3 choices printed on your notice. Let us look at 3 real-world examples that show how this mechanism plays out across different demographics. First is Robert. He is 67 years old and a retired postal employee living in Baton Rouge, Louisiana. In 2007, Robert signed up for the federal long-term care insurance program, known as the FLTCIP, believing that a benefit plan offered through federal employment would provide stable group rates and consumer protections. He assumed the size of the federal government would shield him from sudden rate spikes. That assumption was incorrect. In December of 2022, the Office of Personnel Management suspended new enrollments in the FLTCIP program. That suspension has been extended repeatedly, remaining in effect through at least December of 2026. While existing participants like Robert kept their coverage, they were hit with phased premium increases totaling up to 86% between January of 2024 and January of 2026. Robert's annual premium climbed from approximately $3,100 to $5,700 over those 24 months. He had no option to opt out of the increase while keeping his original benefits, nor was he offered a lower premium alternative. He simply had to pay the higher cost or abandon the program. Robert's experience demonstrates that even federal employees were not insulated from this crisis. It simply changed the entity delivering the rate hike. Our second case is Linda. She is 73 years old, a retired dental hygienist living in Tucson, Arizona. Over the span of 25 years since purchasing her policy in 2001, Linda paid a total of approximately $64,000 in premiums. When she received a major premium increase notice in early 2025, she chose an option that insurance carriers rarely highlight. She selected the reduced paid-up option, also known as a non-forfeiture benefit. By selecting this path, Linda stopped paying all premiums permanently. In return, her insurance company provided her with a locked-in, reduced pool of benefits, amounting to roughly 50% of her original coverage limit, which she can access if she eventually requires care. The reduced paid-up option is not present in every single policy. It depends entirely on whether a non-forfeiture rider was selected when the contract was originally signed. However, it is built into a massive number of policies written between 1995 and 2010. Insurers rarely advertise this choice because it stops their premium cash flow, but it represents a contractually guaranteed right. Third is Frank, a 62-year-old engineer from suburban Minneapolis, Minnesota. Frank does not currently own a long-term care policy. When he began researching individual traditional policies in 2024, he discovered that a standard policy at his age would cost about $4,500 annually. Instead, he explored hybrid long-term care and life insurance contracts. A hybrid policy operates on a different model. You fund the contract using either a single large premium, typically between $50,000 and $100,000, or level payments over a fixed set of years. The policy then establishes a pool of funds for long-term care. If you pass away without ever needing care, the remaining value of the policy is paid out to your beneficiaries as a death benefit. The key benefit Frank identified is that the money is not lost if he remains healthy, addressing the major fear that causes many seniors to let traditional policies lapse. The drawback is the substantial upfront cash required. Frank's situation shows why hybrid products have surged from under 15% of new sales to over 60% of the market in the last 5 years. They address the psychological barrier of paying premiums for a benefit you might never actually use. If you are facing a premium hike or want to prepare before one arrives, here are the 4 concrete decisions you must navigate. I will walk you through the precise steps for each. Decision 1. You must verify that the rate increase has been calculated and applied to your specific policy correctly. While this seems basic, administrative errors on premium notices are surprisingly common. Retrieve your original contract and double-check your policy anniversary, benefit duration, daily or monthly coverage limits, and any inflation riders. Compare these figures carefully against the new billing schedule. Rate increases are approved by class, meaning regulators approve a specific percentage hike for all policies with similar features in your state, but the carrier must apply that percentage to your exact baseline rate, and mistakes happen. Call the customer service line and request a written breakdown of how they calculated your new premium before making any changes. You generally have 30 days from the date of the letter, and you should use that time to verify the math. Decision 2. Check your policy documents to see if you have a non-forfeiture benefit or a reduced paid-up option before you even consider letting the policy lapse. Open your original, complete contract, not the brief marketing summary, and search for terms like non-forfeiture benefit, reduced paid-up, or contingent benefit upon lapse. If your policy has this rider, you can stop making premium payments entirely while maintaining a smaller pool of benefits. This is completely different from letting a policy lapse, which wipes out all the money you have paid over the years and leaves you with zero coverage. The non-forfeiture option is a binding contractual right, not a favor from the insurance company. If your policy contains this feature and you decide to stop paying, you must submit this election in writing to the company before the grace period ends. This grace period is typically 31 days after the premium due date, though you should confirm the exact timeline in your contract. Decision 3. Perform the self-insurance calculation before making a final choice about keeping or dropping your coverage. This is a critical mathematical exercise that most policyholders never do. The calculation requires two inputs and a direct comparison. First, calculate your total premiums paid to date plus all projected future premiums at the new rate through age 90, which represents a standard actuarial planning age. Second, determine the realistic cost of care you would face if you needed it. Use the national median cost for nursing home care, which is currently about $100,000 per year, and combine it with the federal government statistic that the average long-term care need lasts approximately 2.5 years. This sets the total average exposure at $250,000. If your projected total premium payments through age 90 exceed $250,000, keeping the policy at the new rate may not make financial sense. However, if your projected total premium outlay is significantly lower than that $250,000 care exposure and you lack the personal assets to cover that cost out of pocket, maintaining the policy, even with the higher premium, remains a rational choice. This math does not dictate what you must do, but it replaces panic with objective numbers. Decision 4. Determine if you can apply Section 334 of the Secure 2.0 Act to your premium payments before you pay them with standard personal funds. This is the federal rule that went into effect on January 1st, 2026. Under Section 334, individuals can withdraw up to $2,500 per year from an IRA or a 401k specifically to pay for qualified long-term care insurance premiums without paying the standard 10% early withdrawal penalty. For those under age 59 and a half, this is a major policy change, as pre-retirement withdrawals normally trigger both standard income tax and the 10% penalty. While you will still owe regular income tax on the withdrawal, the 10% penalty is completely waived when the funds are used for qualified premiums. For those already over 59 and a half, the penalty waiver is less significant since the penalty does not apply after that age anyway. To qualify, your policy must meet the definition of a qualified long-term care insurance contract under Internal Revenue Code Section 7702B. Standard individual policies from major licensed carriers almost always meet this standard, but you should verify this with a tax professional. When filing your annual taxes to report this exception, you will use IRS Form 5329, which covers additional taxes on qualified retirement plans. Here is an advanced strategy that very few policyholders are using and one that most insurance agents will not bring up because it requires linking your insurance decisions with your retirement accounts, a topic outside most agents' expertise. Here's how the strategy works. If you hold a traditional long-term care policy with an inflation rider and you receive a major premium increase, you can request a reduction in your benefit period, meaning you shorten the number of years covered rather than lowering the daily benefit. This reduction will bring your premium down to a level that can be fully covered by the $2,500 Section 334 IRA withdrawal. You then pay this reduced premium every year directly from your IRA or 401k without penalty. The result is that you convert an expensive out-of-pocket expense into a tax-deferred distribution that you would have been required to withdraw eventually anyway. You preserve your core coverage, eliminate the direct out-of-pocket burden, and keep the annual premium under the $2,500 penalty-free limit. When should you avoid this strategy? Do not use this approach if the benefit reduction required to lower your premium to $2,500 is so drastic that the remaining policy offers no real protection. For instance, if you have to cut your benefit period from 3 years down to 1 year, leaving you with a policy that only covers $100,000 of a potential $250,000 exposure, the policy may no longer be viable. In that scenario, the self-insurance calculation from Decision 3 will likely show that your money is better spent elsewhere. This is a precise financial calculation that depends on your specific policy terms, your retirement account balances, and your overall assets. Run the numbers carefully before you commit to this move. Let us look at where this leaves us. Currently, the typical long-term care policyholder in the United States pays about $4,000 per year in premiums. With the major wave of rate hikes approved between 2024 and 2026, that same group of policyholders can expect their annual premiums to rise to between $6,500 and $8,000. Over a 30-year period of paying premiums, that difference is not a small discrepancy. It represents between $60,000 and $90,000 in extra out-of-pocket costs, in addition to the premiums you have already paid into the system. The 30-day response window on your rate increase notice is not a casual reminder. It is a strict deadline with permanent financial consequences. If you do not elect a reduced benefit option before that window closes, you lose the opportunity. A non-forfeiture benefit that you fail to claim can result in the policy lapsing with zero return. And the IRA withdrawal strategy under Section 334 cannot be applied retroactively to premiums you have already paid out of pocket. This decision is easily worth the 14 minutes you have spent today understanding it. If you found this analysis helpful, clicking the like button helps this channel share this research with the seniors who need it most. Please subscribe to ensure you do not miss our next video, which will expose a specific Medicare Advantage tactic that costs the average enrollee between $900 and $2,000 per year in out-of-pocket expenses, costs that a standard supplement plan would have covered in full, and how to determine if your current plan puts you at risk before the next open enrollment period opens. Before you leave, if you have a parent, a grandparent, or a neighbor who is paying for a long-term care insurance policy, please share this video with them before their next premium notice arrives. The retirees who are hit hardest by these increases are often the ones least likely to research their options online. Taking 30 seconds to forward this video could save them thousands of dollars, whereas their window to make a decision is brief. This channel is for educational and informational purposes only. This is not professional insurance, financial, or legal advice. Consult a licensed professional before making any insurance or financial decisions. I will see you in the next video.